Ticker symbol WING is down over 35% in the past year, and today we'll be looking at a highly efficient growth machine which may have been overlooked by the market, as in the same time period where their stock has dropped by so much, their net income has risen by over 55% in the past year. Additionally, they have faced consecutive quarters with predictable net margin expansion in a super consistent fashion. Today we'll be looking at none other than Wingstop, a restaurant franchise company. In their annual report, they state that they are the largest fast casual chicken and wings focused restaurant chain in the world, with over 2,550 locations around the world. I'm sure a lot of us have already been to a Wingstop, but in case you haven't, the image that you can see basically depicts their most common offering, and they're dedicated to serving classic wings, boneless wings, tenders, chicken sandwiches, which are always cooked to order, and they come in over 12 distinctive flavors. And the great part about this company, which I just found out while researching this video, is that they are a franchisor, and over 98% of their restaurants are currently owned and operated by independent franchisees. But what exactly does this mean to Wingstop's business model? Well, it means that they're able to generate revenues by charging royalties, advertising fees, franchise fees, and by even operating the other 2% of their own restaurants. But what this really means is that they are able to rake in a very large amount of profits with very high margins and with very high efficiency ratios, because this business model basically means that the company is very asset light, which improves all the different efficiency ratios such as return on assets, return on capital employed, or even return on invested capital. And what I like about this company again is that even though it's a fairly simple business model, they still provide us with the 3 different ways in which they're trying to grow out into the future. The first one being that they want to sustain long-term same-store sales growth. This means that inside each different franchise that they own, they want to do the best in order to make those clients that go to those same stores spend more. This may be by ordering a lot more, by ordering more expensive, or just by going more frequently to the restaurants. Number 2, I'm very happy to read out, it's maintaining best-in-class returns. They want to focus on those efficiency ratios, they want to focus on the number side of the business, which is essential, and when you're looking at a franchise company, it's the key to success. And finally, number 3 is that they want to expand their global footprint. What does this mean? Well, they want to open a lot more Wingstop franchises all over the globe in order to expand their presence. And as I stated previously, their financial analysis looks amazing. Remember that this is a restaurant. Well, it has a return on capital employed of over 27%, which, just for you to put it into context, our usual threshold is anything over 15% is a solid company. Then they have an 8 times interest coverage ratio, which we would have wanted it to be a bit higher, above 10 times, but then they have a solid cash conversion, 67%. We would also like this to be a bit higher. We usually look for a cash conversion above an 80%. They have an amazing gross margin of 85% and a very solid net margin of 17%. And this is what I was talking about. Their revenues have been growing every single quarter at a very predictable pace. Their gross margin and their net margin have been rock solid, with their net margin increasing every single quarter at a very small but a very consistent, predictable pace. If this can keep going on, I'm sure that this company will be a big winner in the stock market. And now when we look at their efficiency ratios, these generally follow the net income, which is why these have been rising slowly but surely over time, with their return on invested capital sitting at above 15%. And here comes the first red flag, which is when we do their balance sheet, we can see that their total liabilities are way above their total assets, resulting in a current ratio that is not beneficial for investors. And generally, to me, this is a very big red flag which should be further investigated just to see what's going on. However, I do have to mention that in franchise companies such as Domino's Pizza, this is fairly common. Now when we look into their fundamental analysis, Wingstop gets a solid 5 out of 8 ticks. Why only 5? Well, because of, first of all, their low liability risk, as we discussed in the first slide. They have an 8 times interest coverage ratio, which should be above 10 to meet our thresholds. Then I don't believe they have a solid balance sheet, as we have just seen that their total liabilities are way above their total assets, resulting in a negative equity, which can generally raise questions and is a red flag for me, which should be investigated further. And last but not least, although their free cash flow generation has been growing over time, it is not consistent and it is not predictable. If you were to forecast next quarter's cash flow generation, it would be very hard to do so. But you can believe that over the long term, these will keep increasing. But this company has a lot of positives, because it pays a stable dividend which has been rising and is prone to special payments every now and then. They also use a lot of this free cash flow that they generate in order to conduct share buyback programs and accelerate that value that they're generating to their investors. As I mentioned, their free cash flow is growing organically because it's mainly being enhanced by that organic revenue growth. And by organic, we basically mean that they don't require M&A activity in order to increase their top line. But now the two most important factors, which are the pricing power and their existing moat or competitive advantage. And I believe that Wingstop meets them both. The first one, which is their pricing power, we generally define as the ability to increase your prices at a faster pace than inflation for a long time without losing too many customers. I'm going to just put you in an example where you can define how much pricing power Wingstop actually has. Imagine you're going to a restaurant that you like a lot, and you go there a couple of times every year, you enjoy their food, you love the atmosphere, you believe it's a unique experience, and the pricing is not bad. Well, you generally keep repeating year after year because you're already creating very good memories in that establishment. However, over time you start to see that the prices of the restaurant start to rise. But this does not worry you, because initially the prices were considered a bit low and they're just catching up to the rest of the market, where other restaurants around the area are also increasing their prices. However, over time and as time goes on, you can see that clearly Wingstop's prices are rising at a faster pace than any of the restaurants around the area, and they're very soon higher than all of your other favorite restaurants. Well, without thinking twice, you will start to go a lot less to these restaurants and start enjoying the other ones. What I wanted to show here is that restaurants do have pricing power because they do have the ability to increase their prices along with inflation or a little bit more. However, the moment that they start to raise prices above the rate that every other restaurant is raising them at consistently over time, consumers will actually get tired and will start to slowly stop going as often to those restaurants, which will generally result in declining sales. Well, this means that I believe that Wingstop does have pricing power, but they have to be very careful when using it, because the restaurant industry is a lot more sensitive to these kind of developments. And now when it comes to the existing moat or competitive advantage, at the end of the day, anyone can start a restaurant, there are not huge barriers to entry, your food must be good at an affordable price, and have a good atmosphere so that the clientele can enjoy where they're dining at. However, Wingstop has one thing that most restaurants around the world don't, which is their brand name. Only very powerful chains have managed to achieve this, such as McDonald's, Burger King, Domino's Pizza. You get the point. These chains and these restaurants bring in consumers that just want to play it safe whenever they're looking for a restaurant to eat out. Instead of innovating or trying something new, they know exactly what they will get, what quality, what flavor, and what atmosphere when they go to these kind of restaurants. But additionally, when these chains grow to these sizes, they get the advantage of economies of scale, where they're able to negotiate prices for the different materials they use, for the different softwares, and all the different costs that they have, because it is more likely for a company, for example, such as Uber, to offer better conditions to Wingstop than to an independent wing restaurant around the corner, because it brings a lot more business volume. Now, when we look at their dividends, we can see that these are a bit all over the place, with a lot of different quarters bringing special dividend payments. If we were to zoom in and just focus on the payments without these special items, we can see that their current dividend yield is a 0.43% at a 26% payout ratio, meaning that they still have quite a lot of room in order to keep increasing their dividends, but we can also see that these have been extremely consistent. And when we look at their valuation analysis, we can see that currently they're trading at a valuation which is a lot lower than the one they have been trading for the past 3 to 4 years. However, they're still trading at a hefty valuation close to a 60 price to earnings ratio. I mean, I know they're a fast grower, but it's still a restaurant. And when we look at their free cash flow yield, they're currently yielding a 1.65%, which is a lot lower than the 3% long-term inflation rate, and suggests that this company may be overvalued at current prices. When we look at the risks and possible challenges, I mainly see the worsening competitive landscape, as I stated previously, that despite them having a competitive advantage, this is an industry where there are not very high barriers to entry. So any competitor can just enter the market, come in with a better offering, a better product, and a better atmosphere, and just start to chip away at Wingstop's market share without them being able to respond in a very fast manner. In order to tackle this, what they must do is to keep being consistent, keep offering those unique experiences that they do, and keep bringing that quality that they have been able to bring for a long time. And the second risk that I see is the risk for economic downturns or the cyclicality. As whenever the economy is booming and people are doing very well in terms of their financials, a lot of people go out to eat. However, when there is an economic downturn, a lot more people start to stay at home, and eat at restaurants at a less frequent rate. Now, Wingstop is not a super premium restaurant, but all restaurants get affected by this cyclicality, so it's something to keep in mind. But now, before we move on, please remember that I'm not a financial advisor and this is not financial advice, so please do your own due diligence. However, I believe that this company has a strong competitive advantage and it offers a high return on capital employed. However, they're still not generating consistent cash flows and they're not predictable, which is why I believe that this is a good company and it may be a good investment. However, I believe they're trading at a very hefty valuation in comparison to their growth. Having said that, thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content and I'll see you in the next one.